Bank stocks were down in Asia this morning, then Europe and the US, after a week which saw first the collapse of two US banks, then an anxious market losing confidence in the troubled giant Credit Suisse. Its bosses forced to accept a takeover by arch Swiss rival UBS.
If Credit Suisse had failed completely, there would have been a significant loss of confidence in the Swiss banking system, but that would also have spread across the world with a loss of confidence, perhaps people anticipating that it would be a set of dominoes and we'd be back into 2008.
Rushing to offer reassurances, the European Central Bank and Banking Authority said the European banking sector is resilient with robust levels of capital and liquidity. In a statement, the Bank of England said the UK banking system is well capitalised and funded and remains safe and sound. And analysts aren't expecting a repeat of the 2008 crash.
Those bigger banks that have been well run have built up big cushions to insulate themselves in case of further fallout. There is still going to be concern about what impact there will be on lending going forward. It might be harder to get hold of loans, for example, and this could have an impact on the wider economy.
And what about interest rates? Well, the Bank of England's next decision is on Thursday. There have been 10 rate rises in a row in a bid to curb inflation, and there had been an expectation of an 11th. But now there is concern about how banks are coping with those rising borrowing costs. So all eyes will be on the Bank of England's next move. It's hoped the takeover will improve confidence in banking. But if regulators didn't see the Credit Suisse collapse coming, what else have they missed? And ripples will be felt regardless, not least with potential job losses for some of its 5,000 UK staff. Tessa Chapman, 5 News.